Everyone, welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a down payment assistance loan. So, something very crucial to know as a loan officer. So, good topic to be going over here tonight. Give us just a moment to go live on all the different platforms. You can go ahead and drop a comment there in the chat as you tune in. Definitely appreciate those of you that are tuning in nice and early. All right. It looks like we're live on all the different platforms, so we'll go ahead and get it started here. You can drop any comments you have in the chat and also drop any questions you have in the chat as we go through the presentation here tonight, and we'll answer them afterwards. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is a loan officer training series and a deep dive into a different training topic. Tonight's topic is going to be how to structure a down payment assistance loan. So, very crucial for every loan officer to know this. So, I will let Jose go ahead and take it over. I know you have a presentation ready, so let's go ahead and get into it.
Good evening, everybody. Thank you for joining us for tonight's training on down payment assistance, also referred to as DPA. So, tonight's presentation, how to structure a down payment assistance loan. Now, what I will state as a disclaimer here to all out there is down payment is more down payment assistance. There's a lot of misconceptions as to what it really is. It is an alluring aphrodisiac, is what I like to call it. Right? Sounds really good, but sometimes when you break it down, it may not exactly be what you thought it was, uh, may not meet the objective in the manner that you thought it was going to be met. So it's very critical to understand how these down payment assistance programs work, so you can give the proper consultation to your borrower and make sure you're not just having the borrower chasing, doing a wild goose chase, after something that is not going to be attainable or will not meet their objective. So let's get right into it. We have. Just today I was discussing down payment assistance with one of our MLOs. So truly hope that they are on this training. So, what exactly is down payment assistance? Well, down payment assistance is typically programs that assist borrowers with the required down payment and or closing costs associated with their home purchase. Right? So there's many different options. You have your locally based options, like, for example, Hometown Heroes is a locally based option, which by local, now I'm not just talking about your city. By local, we're talking about it can be funded by the city, the county, or state governments. I think Hometown Hero is a Florida program that we have here. So the locally based option is not the one that we at the Mortgage Calculator typically offer. We're a national company, and the obstacle with the locally based options is that all the company compensation has to match. And where this becomes an issue is because the locally based options uh, will tend to restrict the compensation that is possible to be earned by the company, which is, like I mentioned, the biggest obstacle because all company comp has to match in a given state. So, what do I mean by that? For example, we are, as a company, we are lenders. We are at 2.75 comp. That is our company compensation, and from there is where we pay our loan officers, cover expenses, and all that good stuff. And our loan officers have a certain compensation based on their agreements with us. Now, the issue with the locally based options is that when they restrict the comp that the company can be paid on a loan, that's where the issue arises, because now that option may say that you can't make more than 1.5 or 2% or 2.5% total compensation. So then the only way that we as a company would be able to participate in that program in that given state of, let's say, Florida, for example, is if as a company we lowered our comp in that state to 2.5%. So that's the issue that we face with the locally based programs, and also the issue with the fact that the company has to apply and be approved, the MLO has to apply and be approved. So it does, have those obstacles. And then the other issue that, the locally based DPA options are going to present is on the logistics side. Typically, there's going to be a second approval required. You're going to have to get the first approval for the first mortgage, whatever it may be, FHA, USDA, a first-time home buyer, conventional, home possible, home ready, one of those affordable options. Once you get that approval, then you submit to the down payment assistance agency for their review of the file and issue their approval. So again, you have to take that type of a logistical concern into consideration, as because these are going to be purchases. These are not going to be refis or cash out refis, where the borrower may be willing to wait, but a purchase that has a set timeline on a contract. So these locally based options, like Hometown Heroes, for example, can be combined with FHA, USDA, and the conventional loans, typically 3% down, which would be either the first time home buyer 3% down option, or the affordable option not requiring you to be a first time home buyer, like Home Possible and Home Ready. The locally based programs are also usually going to have income limitations, right? Max amount based on the number of members in the family, because they are looking, to assist in that manner. So again, I put the locally based option out there just to give some context, so that then we can discuss in more detail the options that we do offer at the mortgage calculator, which is the national option, right? The national option, very importantly, does not require the MLO nor the company to be approved by the program, only that the company be approved by that particular lender or investor that offers it, that we were able to submit our loans to them for review and for funding. So that's the key. As long as we're approved by that conduit, by that lender, let's say if it's an FHA loan, then we can offer the program, as long as also that lender participates in the program. Another key component there. So what we have structured today is what we have that is possible with our partners. So another key component here is that the national option does not have income limits, nor any type of restrictions, like for first time home buyer or anything like that. No income limits, no first time home buyer requirements of any type. And we do have repayable options and non repayable, also known as forgivable options. The forgivable one, you don't have to make any payments ever, nor do you have to pay back. And I'll get into that in more detail. The repayable one, you do have to pay back. It does have a set term, but there are reasons why you would choose a repayable option over the forgivable option. Now, be aware that most of these down payment assistance options require borrower paid pricing, which will affect the borrower's cash to close. So obviously, when you're looking at the rate and it's borrower paid pricing, you got to look for the rate that has par plus pricing above 100. Preferably as close to 102.75 that you can get if you're a loan officer at the mortgage calculator, so we can cover the comp without any loan discount fee to the borrower, because that's what ends up happening. If it's a little short, there's going to be on that borrower paid pricing, because what it boils down to is the borrower is going to pay up front, then you get par plus pricing, which offsets the borrower's upfront fee, and you try to offset the full amount of that 2.75 fee with a 2.75 lender credit built into the pricing. The great thing about this is that the option that we work with has amazing pricing, blows the doors off most of the other national DPA options that usually require seller contribution or the full 2.75 to be paid by the borrower, which sort of defeats the purpose of down.
Jose, you turned your mic off there.
Oh, sorry about that. Um, So that was the main difference then in the options. Then, as I was stating, I don't know, I think we lost about 20 seconds there. Is that there are no income limits nor first-time home buyer restrictions. We have repayable and non-repayable, which are also known as forgivable options. And then be aware that most options do require borrower-paid pricing. Right, so it's 2.75 upfront fee to the borrower, which we then try to offset by picking a rate which has lender credit, right? And if it has lender credit, then you try to offset it. Okay, so and that's the biggest challenge I was saying, because the option that we have basically blows the doors off of most of the national options that are going to require the borrower to come in with like 2.75 or 2% in cost to the borrower, which almost defeats the purpose of having a down payment assistance program, which is typically for borrowers with low funds or limited funds to close. So that is the biggest challenge. What we like to, when we're comparing, do we go DPA or do we just try to find an FHA rate with a good amount of lender credit already built in? Typically, with a borrower with good credit score, we can find FHA par plus pricing where it's fully lender paid that still offers 1% and sometimes as much as 1.5% lender credit at rates that are going to be better than the DPA rate. So you don't get the full 3.5% of the DPA. You might get 1.5%, but you're not going to be paying 2 points in fees. So you might end up at the same place, but the DPA at a higher rate and the non DPA at a lower rate. So that's always the analysis to make. So, what are some of the transaction details that we're talking about here, right? Well, first and foremost, purchases only, right? No cash out refis or refis, because that really defeats the whole purpose. This is down payment assistance, and you can only have a down payment if you have a purchase. This national program, now again, I wanted to emphasize what I am breaking down here in these slides are the national program that we can offer. I just shared the info on the local programs just so you can see how this is a little bit different. So this national program can be combined with FHA or USDA loans. So just imagine that 100% financing on a USDA loan with 3.5% of the purchase price in forgivable DPA, which can be used for the closing costs, can result in a cashless transaction. And keep in mind also that the forgivable option does allow, and the repayable does allow for 100% of the borrower's required cash to close, meaning their down payment and their closing costs can all come from down payment assistance if you can structure it that way, or down payment assistance plus seller credit if you can structure it that way. If you're in a market where sellers are open to giving seller credit for the right price, you can structure with down payment assistance and seller credit a full cashless transaction, and with some other options I'm going to show you in a minute, full cashless transaction as well. So eligible properties, well, eligible borrowers, first of all, is first and foremost, no, again, I repeat, no first time buyer nor income restrictions on our national DPA option. So it doesn't matter how much money you make, and it doesn't matter if you're buying your third, fourth, or fifth home. Obviously, it's for primary homes only. Keep that in mind. I'm just talking about in general, first time home buyer is somebody who hasn't owned the property in the last 3 years. Well, no first time home buyer nor income restriction on this one. And eligible borrowers are U.S. citizens, non-permanent resident aliens, and permanent resident aliens. Unfortunately, ITIN borrowers are not eligible because they're not going to qualify for an FHA nor USDA loans. And foreign nationals are also not eligible because they're not going to qualify for an FHA or USDA loan either. And our eligible properties are single family residences, both detached or attached, PUDs, which is basically a single family detached or attached in a community with a homeowners association. That's a deed restricted community, basically that pays an HOA fee. That is a PUD. A condo, and I'm sorry, that's a little typo there, and I can fix that in a minute. There you go. So eligible properties are single family residences, detached or attached, PUDs. Condos are also eligible. Duplexes, and by a duplex, depending what part of the country you're in, you may not refer to it as a duplex, but a duplex is a 2-unit property where the borrower lives in one side and rents out the other side legally and can derive income to help them qualify for the loan. So we do allow a duplex for this loan. There is a little bit of a loan level price adjustment for a duplex. I think it's half a point to be able to finance the duplex under DPA. And great news, we also allow manufactured homes, but there is also a loan level price adjustment. I think it's 1 point to be able to finance the manufactured home with down payment assistance. But the good news is it is possible. So let's break down the options here now. Let's talk about our national forgivable DPA option. Now, the forgivable DPA option offers a borrower 3.5% of the sales price to be used towards the cash to close requirement. And it can be depending how you structure the deal. Remember, if you got seller credit as well or interested party credit, from the realtor, that 3.5% may cover the whole amount. That would be the down payment if you got the closing costs covered. Minimum 620 score for this option. The forgivable option does have the lowest credit score of both options. The repayable is 660 because the rationale here is that the borrower who's looking for the forgivable option is looking really not going to be so much concerned with the rate, really needs the assistance. So they're breaking it down to let them go down to a lower credit score. Now, this can be combined with FHA or USDA loans only versus forgivable versus the repayable, which is for FHA only, not USDA. Now, the good news here as well, a lot of good news for this program, no interest accrues and no payment ever. And good news keeps coming. It is forgivable after 5 years or 60 payments if you are current on the first mortgage. Now, what I will note is that it is a higher cost and rate than the repayable option. And this is usually would be the only reason to select the repayable option, right? Because why would you walk away from free money? And the reason is going to be this. When I've calculated the difference in the payment between the forgivable option, which is just one loan, and the repayable option, which is 2 loans, but the interest rate could be 1.5% lower in interest rate between one and the other. And I've usually found that the combined payment, even with that extra second mortgage, is going to be $50, $60, sometimes $100 lower per month for the repayable option than the forgivable option. So what may end up happening is you may not qualify for the forgivable option because of the higher payment due to the higher rate, and then you may have to go with the repayable option. Still a good deal, but you got to make a payment, which we'll get into in the next slide. Now, this, as I mentioned a couple of minutes ago, can still be combined with seller credit or interested party credit from like the realtor for a true no money needed transaction, because the the 3.5% down minimum cash required from the borrower on a FHA loan, for example, can be met by the DPA. Now, the maximum DTI is determined by automated underwriting. So you can't say it's 45, 50, whatever. If DTI, if AUS, in this case it would be DU, approves it, we're good to go. Now, in order for the loan to be forgiven, right, it must remain owner occupied as well through the 60th payment. So not only do you have to be current at the time that you want to have the loan be forgiven, but you also still must reside in the property, because if at any time you move out of the property, that loan, the first loan can stay there, but the second loan, the DPA loan, would have to be paid back if you move out of the property. And critical that I mentioned here, right, when we're talking about pricing, this is borrower paid pricing on these options. Right, when you're looking at the rates, you're going to be looking on their rate sheets, borrower paid pricing. So make sure to check the cost on the rate and act accordingly. Again, you want to get a cost that includes a lender credit so that you can offset the borrower paid fee with the lender credit on the rate. Sometimes you can make it all the way. Sometimes you end up being a little short and the borrower has to come in with like a quarter point or half a point. If you want to keep it at the lower cost, it's going to be the rate probably a little bit above 8% is going to be the rate for the lowest cost option on a DPA to fully take advantage. So see, they're doing a little bit about what I suggested. They're raising the rate to contribute. So some of the money comes from the DPA agency, and I'm sure some of the money comes from the participating lender in the form of a silent lender credit, right? More or less. And like I mentioned already, 2-unit properties are eligible. That's pretty exciting for our house hackers out there, right? Ultimate house hack, get DPA, no money down at all out of your pocket, and get a duplex. That's a sweet deal, house hackers. And now our national repayable DPA option. Again, no income nor first-time homebuyer restrictions. Now, the down payment assistance for this program, the 3.5% of the sales price, which is what we have, the assistance is equal to 3.5% of the lower of the appraised value or the purchase price, right? This and the assistance is provided as a fixed rate second mortgage at a 9.99% interest rate with a 30-year amortization, but a balloon payment due at the end of 10 years. So at the end of the 120th payment, the loan is due. At that point, hopefully the borrower you've already refinanced them out of that combo loan into just one loan. 10 years is a long time. I'm sure rates are going to be a lot lower in a year or two, where then that borrower, you could reach out to them or they could reach out to you and you could refinance them out of the first and the second into a new, lower, no mortgage insurance, conventional first mortgage at an 80% loan to value, and you're going to really lower their monthly payment all the way around. No MI, no second mortgage payment, and an interest rate that's probably going to be 2% lower than what you currently have right now. That'd be win-win-win. And then on top of that, maybe even get a little cash out, right? That would be awesome. Or at that point, maybe they could even buy the next one. The repayable option is a minimum 660 credit score, and it can only be combined with FHA loans. You cannot combine, for whatever reason, that's in their guidelines. You cannot combine the repayable option with a USDA, only for FHA. And it again may be used. The repayable has the same feature as a forgivable that may be used for up to 100% of the borrower's cash to close requirement. Never eligible for a cash or refi. Never eligible for a refi of any type. This is a purchase option only. maximum DTI determined by AUS. In this case, is going to be DU. We run our FHA loans all through DU, and 2-unit properties also permitted on the repayable option. Now we have another twist because they have a whole bunch of options here. So I'm putting here repayable closing cost option with up to 6% assistance for all cash to close required. Well, not exactly all cash to close, because actually in this option, you got to have 3.5% of your own funds. That's what they call it, closing cost assistance, and not down payment assistance. The assistance is in the form of a 9.99%. Again, the same fixed rate second mortgage, 30-year amortization with a balloon due in 10 years, never income nor first time home buyer restrictions. This is also a lower rate than the forgivable option, and it is offered in 3%, 4%, 5%, or 6% of the purchase price in assistance. Now, usually that 6% is going to come into play, since this is for closing costs, in your lower price properties, right? Where you get $100,000 property, a lot of the costs are fixed costs, not based on the loan amount. So you could end up easily with, and if you're in a high insurance cost area like we are here in South Florida, on a, let's say, $150,000, $180,000 properties, of which there are none here in South Florida, by the way. Just don't want to throw you off on that. But on a lower value property, the 6% could only come up to $6,000 or $8,000 or $9,000, which would barely cover your closing costs. Versus if it's a $400,000 property, you may only need the 3% down option to cover your $12,000 in closing costs, right? So that's the key component here of why you would have a 3, 4, 5, or 6% option. Again, this one can only be combined with FHA loans, no cash back. The DTI max is per automated underwriting, in this case DU, and this one also has a minimum 660 credit score. And in our last slide here, breaking it down here for you on how to set this up for in the LOS, and it seems like my picture got cut off a little bit there. So let me see if I can try to remedy this situation a minute. Give me a second. Seems like it moved a little bit on me. All right. Well, I think you can get most of it there. So we use Encompass here, but you may be using Calyx Point or any of the other LOSs out there, right? But what's really important here is to make sure to set it up properly. Make sure to set the 1003 up properly in your LOS, in our case Encompass, to reflect the gift, so that the AUS submission, in this case DU, picks up the down payment assistance and gives credit for it as an asset. Now, how do you do that? There's basically 2 steps that you have to take here. The first step is that, if this is obviously for Encompass here now, you have to go to the forms in Encompass. That you click on the forms tab, and you look for the Fannie Mae additional data form. And in the Fannie Mae additional data form, you see right there, you're going to click on the downward facing arrow to open up the drop down menu, and you're going to select FHA gift source government agency, right? So when you see that page, you select that in the drop down. And then you'll have to go to section 4D, as in dog, in the 1003, commonly known as page 4, but section 4D, in the gift section. And then you need to set up the gifts. But here it's tricky, because you're not going to find what you need, the federal agency, Fannie, Freddie says right there, unless you first click the tab that I have highlighted there in yellow that says show all gifts or grants. You need to click that so that then it opens up the drop down so that then you can select the agency option and then input the amount. If it's deposited, no. Gift of cash, who's going to be getting it, our borrower or a co-borrower, and that's it. Then you run your automated underwriting. In this case, again, it's going to be to you, and hopefully you will receive your approved eligible. Because one of the things that you issues you may run into, theoretically, it says DPA is available down to a 620, but depending on the risk profile of the deal, you may not get an automated underwriting approval, in which case then manual underwriting is still an option for this loan. But at that point, then you're going to remember manual underwriting is 43% maximum total debt DTI. And there's, could be other restrictions if you're going manual underwriting for this type of loan. So always best if automated underwriting uh, gives you the hit. So again, remember the points that we covered today. One of the key components that you have to consider on these down payment assistance loans is, what is the objective here? How much net money is the borrower going to receive from the transaction? And is there any other way to structure it where they may still be able to meet the mark? Obviously, if they have no money or very little money, then and they still qualify at the higher rate, then they may not mind that higher rate if it gets them where they need to be. Because, like I like to say, 100% of nothing is nothing. And if the loan option with DPA, the higher loan, helps you meet the objective of buying the home, you can always refinance out of that home a year or two down the road when the rates drop a little bit. Property has a little bit of equity. Get into the conventional loan, maybe even get rid of the MI, get rid of that second repayable option, and or if you're in the higher interest rate, just get rid of that, 8.5 or 8.75 or 8% FHA rate into, who knows, maybe a 3 or 4% FHA rate, right? But the key is you own the home already, and you're able to do that maneuver because you used the DPA to buy it. So that's the key. Always be the good consultant with your borrowers. Listen to what their objective and break it down for them so you can make it happen. Looking forward to helping you all structure your DPA loans.
Oh, sorry, I was muted there. Okay, looks like we got some questions here today. A couple of them. Okay, one of them says, "Never mind, just answered." I guess we should pull up the next one.
Yeah, that one was talking about probably the closing cost assistance option, which requires them to have 3.5% of their own funds.
Okay. Next question here: if DPA can be combined with an FHA first, where do we apply for the DPA to combine with the FHA first loan?
Well, that's the beautiful thing about it. This is a streamlined process. Once you submit the loan as a DPA loan structured, how we have it here, like I just showed you in this last slide, our conduit will take care of all of that for you. Once if it's submitted as a loan with down payment assistance, there is no second approval needed. It's all handled in one shot. You don't have to worry about multiple submissions nor multiple approvals, which is another logistical benefit of this option.
All right. Next question is the repayable option DPA similar to a piggyback loan? Also, can you use forgivable DPA instead of a piggyback loan?
Well, I'm trying to figure out if we're talking about the piggyback, if like a combo loan, like an 80-15-5 kind of deal. No, it's really not. It's two totally different things. The piggyback loans it's going to be either a HE loan, fixed rate HE loan, or a HELOC, full term loan, 30 years, not doesn't have a balloon in 10 years, and never forgivable, always repayable. Um, so you really wouldn't be able to offset use a DPA for a piggy bank, because the piggy bank is usually going to be, depending what you're using it for, at least 15% of the loan to value of the transaction, whereas the DPA is 3.5% for the DPA option, and for the closing cost option up to 6%. And the question there, they added to avoid PMI. No, exactly. So yeah, if it's going to be in that manner, no, because you wouldn't be able to reach a high enough of an amount to cover. Plus, the DPA is helping you with your 3.5% down only, right? But it's not going to help you with 15% down or 20%
Remember,
down.
all FHA loans over 15 years have MI for life, right? No matter what the LTV is. So MI is life of the loan. So there is no avoiding MI with an FHA loan.
Oh, true. Another thing, to avoid PMI here now, FHA is always PMI on those loans, no matter the LTV. The only I guess caveat to that is if your initial loan to value is 90% or lower on the initial FHA loan, then I believe when you get down to a 78% loan to value or 11 years, whichever comes first, then they let you cancel it, but you have to start at a 90% LTV, not applicable for the 96.5% or any LTV above 90%.
All right. Okay, I don't see any other questions, so I think we can go ahead and wrap it up. Remember, we do this at 7 p.m. Eastern time on Tuesdays, Wednesdays, and Thursdays. So we will be back next week with some new topics. We appreciate everybody tuning in. We'll see you next Tuesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training